Hi, my name is Susanna. Today I'll be going over the trading and dealing in capital markets. Three cases were provided to us. We will be going over each one of them and spending most of our time over the code because that's the most complex one we were looking at while we worked on it. My group members will be helping me with the different cases. I will be going over the first algo case. The project will be basically on building the algorithmic market making strategy that will automatically connect to the RIT stimulator and will allow us to make those trades. What we did was use the Excel provided and add some code to enhance it to include and adjust for things like big spread and skew of inventory and volatility. All of this was done using VB and Excel and the RIT API, which is the application programming interface. We saw all of this information in real time. So while creating the strategy, we faced some challenges. One of the major challenges that we faced was the inventory risk. That essentially meant that at any given moment, we didn't want too much inventory. Holding too much inventory adds risk, and we needed the price to be neutral. We want to make money on the rebates. As a market maker, you need to ensure that your delta price is always neutral. The other challenge that we faced was volatility. So if the market had a lot of fluctuations between the highs and lows, we wanted to make sure that we compensated for that. You'll see this in our code. The third challenge that we saw was execution risk. Sometimes the order takes a long time to execute, and we wanted to make sure that if we had stale orders in place, we got rid of them and we kept our strategy range really simple so that there's one bid and one ask at a given time. The fourth challenge was that we had compliance. We had very strict rules around what our maximum position size could be, so we had to adjust for that in our code. In terms of key algorithmic logic we used, the code is shown here in the slide. We first initialize the API to be able to connect to RIT. Then we monitor the inventory. That is, we see how much we're holding in real time so that we can adjust our max size. When we used the VWAP calculation, we used the last 20 trades just to make sure that the price that we're getting is very close to where it should be and that the short-term volatility does not affect our price. We also look at dynamic spread because the spread can change between all of these trades. We wanted to make sure that we're capturing the spread at any given moment in time and that there was no volatility. We used a base spread of 2 cents. We have also adjusted for inventory skew, which was covered previously in the main challenges. In terms of core market making logic, I've mentioned that we've only had the ability to submit one order at a time so that we keep it really simple and don't cater to too many stale orders. We also have a function here that cancels any existing orders. In terms of how the bid and ask price is calculated, we look at the VWAP spread in the skew. The skew is really important because if you're holding too much inventory, we won't make any money off of it. Only the spreads and rebates make us money. We want to make sure that we're not holding on to that inventory because our price needs to be delta neutral. When we have then we have risk controls where we monitor and adjust quotes in real time so that it does not exceed our maximum inventory limit. Here we have the VWAP calculation function where we use the last 20 trades. If we're not getting any data, there's a fallback method in there so that we use the last known price. The VWAP allows us to get a fair market price, which is what we anchor our strategy against. So here we're looking at the two helper functions that we've used, which is dynamic spread and the inventory skew. In the dynamic spread, we've given the formula, which is the base spread, which over here is a constant of 2 cents, and we need to multiply it by the volatility and the inventory adjustments. Wider spreads during high trading volume are extremely common, and the VWAP takes care of that. The inventory skew function makes sure that the price at which we acquire the inventory is not too far away from where the market is right now. Here are a few of the other helper functions that we use, like order size control and the risk management. There are various fixed rules that we were given in this case around the order size. Here we can see that our base order size was 1,000 shares. We reduced this order size in a two-step process. When we reach 50% of the maximum order size, the base is reduced to 75%. And when we reach 70% of max, the base is reduced to 50. This helps us reduce the trading gradually and not with a hard stop, and it also gives us a better strategy, which is a more optimal market maker. This also takes care of any kind of compliance risk, like breaching the 25,000 share limit. Here we have some of the theoretical foundation that we based our code with, and some of them are cited here on the slide. Now I'll be giving it over to Laiba.
Thank you, Susanna. Now I'm going to be talking about case 2, which is option strategies. And this case requires us to implement and analyze 4 key option strategies, which are straddle, strangle, butterfly, and condor. Let's begin with a quick overview of each strategy and the market conditions they are best suited for. So the first strategy, which is the straddle strategy, is typically used in high volatility environments. It's designed to profit from large price movements in either direction. And the key feature is that it includes both a call and a put at the same strike and expiry. The strangle, on the other hand, is also suited for high volatility but is more cost efficient. It involves buying out of the money puts and calls, resulting in wider break-even points but lower premiums compared to the straddle. The butterfly, however, works best in low volatility environments. It profits when the price remains close to the middle strike, and essentially we're betting that the market will move sideways and the price will stay near a target level. Lastly, the condor is used in very low volatility scenarios. It's similar to the butterfly but with a wide profit range. However, it comes with capped profit potential, meaning the maximum gain is limited. The strategy implementation, in terms of the instruction, for the straddle, we bought a call and a put at the same strike price and expiry. And for the strangle, we bought an out of the money put and out of the money call, giving us cheaper exposure to volatility but with wider break-evens. The butterfly was a bit more complex. We bought calls at the lower and higher strikes and sold double the contracts at the middle strike. And this structure gives us a sharp profit peak at the target price. The condor extends this further, and it involves buying and selling multiple options at 4 different strike levels, creating a flatter but wider profit zone. And all of these 4 strategies were all implemented over the same time frame and designed to reflect different market views. So on this slide, you will see our payoff diagrams, which visually demonstrate how each strategy performs across different stock prices. These graphs closely resemble textbook models, and they clearly show that the straddle and the strangle pay off profiles with unlimited upside and downside protection depending on the movement. The butterfly, however, shows a narrow but high profit peak centered at the middle strike. Lastly, the condor displays a wider profit plateau but with a lower maximum return. And to conclude our analysis, let's quickly compare the 4 strategies we just implemented. The straddle gives you unlimited profit potential, but it comes at a higher premium. It's ideal when you expect a big move but are not sure of the direction. The strangle also benefits from high volatility, but it's more cost efficient. And the trade-off is that it needs a larger price move to be profitable due to wider break-even points. And then we have the butterfly, which is best for low volatility markets. It gives a cap profit, but if the price stays near the middle strike, it's perfect when you expect little movement. And finally, the condor strategy offers the widest range of potential profit, but it comes with the lowest risk and return. And it's actually useful to use when you expect very limited price movement and want want a broader safety zone. And as we saw in the previous payoff diagrams, each strategy aligns with a specific market outlook. And the key point here is to match the right structure with your expectations for volatility, price direction, and cost tolerance. And now Fatma is going to talk about the case 3. Thank you.
So in this slide, we will summarize the key differences between these two strategies. The protective put provides full downside protection, which is ideal in uncertain or bearish markets, but it's also more expensive, and because we use short-dated options, it needs to be rolled over monthly, which adds ongoing costs. And the zero-cost collar is a cost-neutral hedge. It protects us down to $18, but caps at any gains above $22. This works well if we were willing to trade off some upside for lower hedging costs. We specifically chose these short-term options for greater responsiveness to market movements. And yes, it increases the number of transactions, but it allowed us to stay closer to the market. So our final point will be, by selling the call in the collar, we reduced the hedging cost, but also limited our profit potential in a strong market rally. And in this slide, we have all the references that we used for this assignment. Thank you so much for your time. That's all from us today.